Welcome. I'm Joe Galvin, Chief Research Officer for Vistage. I'm happy to host the latest webinar in our Leading in Challenging Times series. This series provides a definitive source of thought leadership on pressing topics facing small and mid-sized businesses. Combining expert speakers like we have today and peer perspectives is how we help Vistage members make critical decisions that drive growth, especially during the craziness we're experiencing now of the COVID crisis. We've invited Dr. Adrian Cronje back today as a follow-up to our session in April, when Adrian joined me to provide insight for business owners on managing your business through a crisis. And remember where we were in April, as we were searching for the bottom of what we didn't know this would become. Today's focus is not only on how to modify your strategic plan to navigate the next 6 months, but also how to position your business for life after the crisis. Adrian is CEO of Balentine, Inc. Adrian's firm is a long-standing Vistage member. His chairman has been a Vistage member for over 30 years, and Adrian himself has been a member for over a decade. His firm primarily serves business owners at the epicenter of what business owners and entrepreneurs are feeling. As a PhD economist and chartered financial analyst, Adrian has an incredibly unique bird's eye view of what's going on in the markets today. He brings us a unique vantage point to share how CEOs can study markets to understand what the future may hold. Adrian was recognized by Vistage as a top new speaker of 2019 for his presentation on how capital markets lead the economy. And boy, we're going to need that insight today, Adrian. In order to set Adrian up, I'm going to share just a few charts from the Vistage CEO Confidence Index. This is our quarterly confidence index survey that we're now doing monthly, just to try to understand the impact of what the crisis is in our community. And what you can see here in this chart is that our confidence index had been falling steadily from a peak of December of 2017. And then in December, our Q4 confidence index 19, we saw it turn up for the first time, and we thought, wow, the slowdown is slowing. It's time to prepare. And remember where your head was coming into 2020. Those strategic plans, all those great ideas, all the growth we were going to realize, and how quickly that was crushed. You can see in March that it dropped a beginning, but that was March 2 through 9. It was our April survey, or rather our June survey, that shows that we collapsed all the way down to 65.5. And while we don't keep track on a monthly basis, if we had, our April confidence index would have been in the 40s. So we've been asking each month and publishing flash reports each month to try to get an understanding of where our community is. And we just published the economy reaches a first plateau, meaning as we've moved from a level of essential services to necessary services, we've seen millions of people return to work, some degree of normalcy, and in other parts of the country, maybe we opened up too quick and now we're experiencing some setbacks. But let me share some of the data with you. Our first chart looks at revenue. To what degree have your revenues been impacted by the coronavirus pandemic? And the way to read this is April is gray, May is gold, June is a dark blue, and July is a black. And you'll see in our first on the left that no change or increase. That kind of reflects the dip from the fall down to May to now the slow climb back. 0 to 25% down, that really hasn't moved. But when we see decrease 75% or even more, we're seeing slight improvements there, suggesting that the revenue picture has stabilized, grown just a bit, but not really making the type of progress we'd hoped. Our next chart looks at cash flow. Clearly, if the revenue's down, cash flow becomes imperative. And the way to read this is maybe relax your eyes and look at gray, because that is April, light gray, and dark gray is July. And what you'll see is a shift to the positive. As more people have more cash reserves. And we think this is a direct result of the impact of the Paycheck Protection Program. 82% of our members applied, and of that 82%, 98% were funded. So that stimulus into the economy, that stimulus into our businesses has clearly helped cash flow for a lot of people. That means we've got a little bit more runway than maybe what we thought we had. But this next chart, which looks at expectations for when the economy will improve, paints a different picture. The light gray line is April, and you'll see it peaked in 3 to 5 months and 6 to 12 months. The blue and the gold represent May and June, but you look at that July number and you'll see our expectations from the economy will improve continues to push out. In fact, more than 2/3 of our community think it's 6 months or a year further before the economy begins to improve. So clearly we've got a lot of work to do. Clearly there's a lot of uncertainty, and I can't think of a better time than right now to bring Adrian back and get some insight into where this will go and what it will mean for us as we do our planning. So Adrian, thank you so much for coming back and sharing your insights. Let's get started.
Thank you for welcoming me back, Joe. I enjoyed participating in the early days of your Leading in Challenging Times series back in April, and I've enjoyed watching them since. They've been very helpful to me as CEO of Balentine, and I know our CEO group 151 down here in Atlanta have been following them closely ever since. Certainly a lot of water has passed under the bridge since then, so I welcome the opportunity to update everybody on the economic outlook today using those very same tools. Those are the lens of capital markets and the messages they send, as I've been counseling Vistage members to become students of as a speaker for the last 18 months. You mentioned the July CEO Confidence Index, and in reading through that report, I was struck that 22% of CEOs reported that their businesses have already recovered or were not impacted by the pandemic. I find that astounding. Of the 78% of CEOs that are still on the road to recovery, their timeline matches their expectations for when recovery of the US economy will begin. And the majority, 2/3, believe that the recovery of the economy will begin in 6 months or longer, as your slide just showed. 73% of CEOs believe the recovery of their businesses will now take 6 months or longer, even if they have a little bit more runway, Joe, as you said, through the increase in cash reserves. So the bottom line is the dark days of March certainly seem to be a distant memory for so many, even if we've reached that plateau in the first stages of recovery, and we are now steeling ourselves for perhaps a longer than expected road to recovery than we did a couple of months ago. So I'm excited to share with you the updated messages that capital markets are telling us, whether they are telling us that Vistage CEOs are being overly optimistic or realistic about the future. But first, let's quickly set the agenda for what I wish to cover today. My experience has been that whenever I end this talk on the capital market outlook, questions arise from members such as, Adrian, I get it, and I see how this applies to my business, but how should I invest my portfolio and liquidity outside of my business today? Let me preempt those questions today by saying I cannot unfortunately give you specific counsel on that during a webinar like this. For one thing, our views are subject to change. For another thing, specific investment advice requires context, and that is different for everyone. I would, of course, be delighted to have a follow-on call with any Vistage member who would like to explore this further, and please feel free to do so at any time. Instead, today, I also plan to share with you our Balentine investing Cardinals, which essentially means that I've attempted to condense my 25 years of investment experience to 15 minutes of generic takeaways that we think stand the test of time. Long-standing members, by the way, will recognize that I've attempted to write this in the pithy style of Vistage legend Red Scott's famous business Cardinals that I'm sure many members are aware of. And then finally, I'll leave you with some instructions of where to go to find an abundance of complementary resources that relate to what we are discussing today. Let me first start with the key insight I hope every Vistage CEO is aware of. That is that capital markets lead the economy, not the other way around. Indeed, it pains me to admit how limited traditional economic forecasting is at predicting the future, especially downturns over a time frame that is useful for us, like 12 to 18 months, so that we can adapt our strategic plans and pivot accordingly. Relying on economists and strategists to divine the future is a little bit like driving a car by looking in the rear view mirror. Think of economists as cardiologists or weather forecasters. Cardiologists and weather forecasters can give you a sense of the sets of circumstances that are likely to lead to an outcome, but cannot tell you precisely when that outcome is likely to occur, even if they know, the playbook to recover from a cardiac arrest or indeed a storm. In other words, their theories are not wrong. The real Achilles heel of traditional economic forecasting is that their inputs into their models are backward-looking and subject to revision. On the other hand, capital markets are forward-looking indicators. They represent the informed views of thousands of investors about the future and the madness or indeed wisdom of crowds handicapping the effects of key issues that affect the near-term outlook, such as coronavirus, tariffs, the Cold War with China, the oil price collapse, the upcoming election and its effect on policy, whatever the issue of the day is 12 to 18 months out. And in setting these forecasts, ultimately investor behavior of greed, excessive optimism, and fear, excessive pessimism produce predictable cycles in capital markets that evolve slowly over time from euphoria to despondency and back again. And that typically takes several years to unfold. The challenge of 2020, of course, is that we experienced two black swan events, as we discussed in April, that meant that we never really reached euphoria in late 2019, but jumped to despondency in a 3-week period back in March from the great lockdown to contain the coronavirus pandemic, compounded by an epic oil price collapse that ultimately ended with negative oil prices. We discussed this a couple of months ago and how to manage your business through the crisis and beyond at length. And I am proud of the counsel we gave then, which was essentially, don't panic or capitulate by succumbing to emotional, irrational pessimism at the time. Since then, capital markets have recovered dramatically over the last few months, leaving many to wonder today about what the great disconnect after the great lockdown is all about. Capital markets have recovered substantially all of their losses, and an economy and labor market that are still registering near depression-like readings are confusing many. Will the recovery look like a V, where we recover 2019's peak economic activity by late 2020, within 6 months? Will it be a U, where it won't take until 2021, at least 18 months to do so? Or will it be somewhere in between, a little bit like a Nike swoosh, as the Wall Street Journal characterized it a few months ago, where the previous high water mark may generally be regained during the first half of 2021. So to answer that question, let's take a look at what the capital markets are telling us today. As I've said before, the 4 key capital markets I encourage everybody to monitor are the stock market, the bond market, the credit market, and the commodity market. And the reasons are highlighted on the right-hand side of this slide. The stock market gives us a good view into what future corporate profitability looks like. There has never been an economic recession in the United States without a corporate profits recession. There has been a corporate profits recession without a recession occurring, which is why, as Paul Samuelson, the Nobel laureate, has reminded us, the stock market has actually predicted 9 of the last 7 recessions. So it's a powerful look into future economic activity, but it's not a fail-safe indicator in tandem. The second indicator is the bond market. And here, the slope of the yield curve, or the difference between short-term interest rates and long-term interest rates, gives us as business owners a clear view into the future direction of interest rates and Federal Reserve policy. The third is the credit market, or the ability of corporate America to finance itself outside the traditional banking channel. So corporate bond markets are really a good proxy for CEO or CFO optimism. And the fourth is the commodity market. And in a moment or two, I will remind you all how important the global context is for the US economy. You know, in 08 and 09, when we entered the great downturn, we still produced the majority of global GDP. Today, of course, we are still by some stretch the largest and most diverse economy in the world, but we no longer produce the majority of global GDP. Countries such as China, Russia, India, Brazil, and other emerging markets have really grown in stature, and their contribution to the global context can no longer be ignored. And so the old saw that the global economy does not go into recession without the US going into recession first can no longer be taken home to the bank. And I think that's a key insight for us Vistage members, because so many of us are operating small to medium-sized businesses that are not really dependent on the global economy. So it's really important to keep an eye on that fourth indicator. And the sequence of the shoes to drop before a downturn, which is mirrored during a recovery phase, is as follows. Typically 12 to 18 months before a major downturn, the slope of the yield curve goes negative. In other words, long-term rates fall below short-term rates, because the expectation of the bond market is that short-term rates have to go lower in order to stimulate the economy from a downturn. Indeed, over the last 40 years, up until recently, with the exception of the exogenous shock of the coronavirus pandemic, there has not been a recession without the yield curve inverting 12 to 18 months out first. The next shoe to drop is typically 6 to 9 months out. The equity market approaches a bear market or a peak to trough drawdown of around 20% and a lot of volatility as it begins to discount corporate profitability rolling over. And then 6 months out, credit spreads tend to widen as corporate bond investors anticipate greater defaults from a slowdown, along with commodity markets going into a bear market as commodity investors expect the global economy to roll over. And so the key insight is don't use any one of these key indicators in isolation. Use them in conjunction with each other. And the resource that I've highlighted down below in the slide can walk you through all the details that are relevant in putting the pieces of the puzzle together. So let's make a couple of brief comments about each of these key capital markets. The first is the equity market. And on this particular slide, I have shown just how long and smooth and grinding a bull market we've had up until March of this year. Two key takeaways from this slide. The extent to which US stock markets in dark blue have outperformed international stock markets in light blue has been enormous, almost unprecedented. And secondly, up until recently, notice how smooth the ride for equity investors have been. It really was not until the fourth quarter of 2018, and of course in March of 2020, that we approached anywhere near the normal level of volatility that equity markets are accustomed to delivering. And so the key takeaway here for investors as an aside is not to throw out the idea that diversification is a bedrock for risk management of portfolios. Just because US stocks have outperformed international stocks for a long period of time does not mean that they are divinely ordained to do so in the future. But just as importantly, beyond diversification, as we discussed during our webinar in April, the need for building resiliency into portfolios is paramount. Exogenous shocks, unforeseen events that have large consequences, such as a global health pandemic, such as 9/11, require investors to keep sufficient cash on hand in their portfolios to make sure that they do not take emotional action at just the wrong time to impair capital. And by the way, that is the same advice I give CFOs and CEOs when managing their business. Always have enough liquidity and credit lines on hand to make sure that you have runway, as Joe articulated at the outset, to take a longer term view. So let's zoom into this year. It's really remarkable, not just how quickly the market crashed in March, drawing down by more than 30% peak to trough. What has really been remarkable is even after the National Bureau of Economic Research declared that we were in a recession in dark gray, just how quickly stock markets have recouped substantially all of their losses. And I receive a lot of questions about this apparent disconnect of us still experiencing a severe recession, but why is the stock market remain so ebullient? And the first comment I would have to that question is to remind you all that the stock market is a long duration asset. And by that I mean over 90% of the value of the stock market comes from investors' expectations of corporate profitability 1 year hence. In other words, stock markets are looking through the current deep divot in economic activity during the second quarter and the third quarter of 2020 and are looking to an aggressive recovery in profitability in 2021 and beyond, coming from a couple of key themes. First, and most importantly, effective therapies and vaccines that will be abundantly available in 2021. And here in recent days, the news about so many of the trials have been very positive. And secondly, I know that you've explored this, Joe, in your series, the acceleration of trends that were underway pre-pandemic, and that is the rapid assimilation of technological advances by businesses during the Great Lockdown. And here I'm not just talking about our ability to communicate with each other over webinars. I'm talking about the digital payment system coming online, the broader use of the blockchain protocol, artificial intelligence protocols and what they can do to boost productivity and automation. And so that may well act to boost corporate profit margins over the coming months. Of course, the stock market is now beginning to worry about the political cycle in November and the potential for a Democratic sweep, where candidate Biden has made it clear that a priority for his administration will be to roll back corporate tax cuts to fund longer-term spending priorities like infrastructure. And this, of course, will handicap corporate earnings expectations next year. That concern about the political cycle is being offset by calls for another stimulus in the next few weeks. In fact, some estimate that to be likely in the order of another $1.5 trillion, or over another 5% of GDP. Of course, President Trump's administration has every incentive to get it done, as polls in the key battleground states and constituencies show disapproval of their handling of the pandemic. They argue that the basis of the stimulus increase is due to rising COVID cases, shortages of testing equipment, renewed focus on school reopenings, and the economy softening a bit off of the bottom we experienced in the second quarter of this year. They, the bottom line, know recessions are notorious for killing re-election chances. And so they have every incentive on the eve of the election to make sure that this legislation passes. I would argue that we all need to steel ourselves for greater volatility, as this legislation is likely to attract less bipartisan support that the CARES Act received during the depths of the crisis in March. To give you a sense of just how deep the divot is in corporate profitability, second quarter earnings season got underway a couple of weeks ago, and consensus estimates were for corporate earnings to contract quarter on quarter by 45%. Think about that. As a result of the underlying earnings base contracting so sharply, the as-reported price-to-earnings ratio of the S&P 500 is now at 27 times. A very high valuation, but not as high as 2008 or even the 2001 recessions. The bottom line being the stock market is looking through near-term challenges to a recovery in 2021 and is beginning to discount the fact that progress towards a medical solution and perhaps at worst for a divided government with a President Biden offset by a Republican Senate to stymie corporate tax increases will allow for somewhere between a V-shaped and a Nike swoosh-shaped recovery. Before we leave the stock market, I want to remind you all of a quick caveat. These have been general statements that I've made about the stock market, the S&P 500, a broadly diversified temperature check on corporate profitability. Beneath the surface of the stock market, there have been huge divergences in the fortunes of growth stocks. So those are stocks that have a demonstrated ability to grow top and bottom line earnings, especially those that have had resilient, high quality balance sheets, which have really outperformed value stocks. Growth has outperformed value for over a decade and has accelerated during the lockdown, opening the biggest divergence in performance since the late 1990s. Technology and healthcare have experienced a V-shaped recovery, whereas financials and energy and consumer discretionary, especially those in the leisure and travel and hospitality industries, are likely to continue to experience a bit more of a U-shaped recovery. The pandemic really has widened the disparity of a two-speed underlying economy, one where technological and medical innovation and resiliency has trumped the more fragile, older industries. I mention that because any shift in leadership of value over growth that's sustained in the coming months could be a canary in the coal mine that the broader market is willing to expect a bit more of a V-shaped recovery than that Nike swoosh-shaped recovery that it appears to be positioned for today. So keep an eye on that. Let's talk a little bit about the bond market. And many of you who have heard me before have seen this slide, but this in dark blue is essentially the slope of the yield curve, or the difference between the 10-year Treasury bond rate and the 2-year Treasury bond. There are a variety of ways of measuring the term premium along the yield curve, but here is the key insight. It highlights the important role that the bank lending channel plays in our economy. Think about the banking system, their ability to make profits by taking deposits in short and lending long is really facilitated by a positively sloped yield curve, because that provides a tailwind, essentially because short-term rates, their cost of finance, are below long-term rates, their earnings. And what you'll see from this slide is outside of exogenous shocks like 9/11 or coronavirus on the right-hand side, this yield curve turns negative 12 to 18 months before a recession. And as I said before, there has not been a recession in the United States for nearly 5 decades without this yield curve going negative. And so the key insight here is the Fed is anxious to avoid any contraction in the bank lending channel, as they view that to be a powerful disinflationary force to the economy. If we as businesses can't borrow from banks easily, that disincentivizes us from taking risks to hire people or to invest for the future or for consumers to spend. And so that, on the next slide, puts into context the bold action they took in March. As I said, in April, they clearly learned their lesson from the slow and reactive response to the 2008 and 2009 great financial crisis, and have attempted to set the stage for a quicker recovery this go around by promising to do 3 things. They moved interest rates to 0. Secondly, and this is a very profound change for them, they have promised to buy assets in unlimited quantity and backstop stress in the money market, municipal bond market, and corporate bond markets. And I'll show you the extent of the shock and awe that this has meant for their balance sheets in a moment or two. And just recently, they've provided forward guidance. And by that, I mean that they do not expect short-term interest rates to rise again through the end of 2022. So get ready for a long period of low interest rates. Essentially, they have flooded the economy with liquidity, allowing markets to reach the plateau that Joe talked about and to see through the sharp recession that we are currently experiencing to hopefully a pretty robust recovery at some point next year. You'll see on this particular slide how the yield curve is steepened, as the Federal Reserve, through these actions, have so far avoided the abyss of negative interest rates that have plagued Europe and Japan for the last few years, undermining their recoveries. Essentially, the bond market, like the stock market, is saying that the general recovery is likely to be somewhere between a V-shaped and a Nike swoosh-shaped recovery in 2021. The third market to pay attention to is the credit market, or the market for corporate bonds, because they tell you about corporate America's ability to finance itself outside of the traditional banking channel, as I said earlier. This particular slide shows that high yield or lower quality corporations over the long haul have had to finance themselves with a premium on average of 500 basis points or 5 percentage points over safe treasury bonds in order to entice investors to finance them. Once that spread rises above 500 basis points, that is the corporate bond market saying that we're in the beginning of a slowdown or approaching a recession, as they are anticipating greater defaults. And so you can see just how the Federal Reserve's actions of backstopping the corporate bond market had an effect after they blew out in early March. Just how stunning they reverted back after the Fed's shock and awe intervention has been an untold story of this year. I will quickly point out that they remain elevated and are, unlike the stock and bond market, clearly signaling a more U-shaped, perhaps longer recovery in 2021. My longer presentation implores everybody to keep an eye on the corporate bond market, because when you disaggregate the various sectors, you get a very good sense of which sectors are recovering quickly, which sectors are likely to be permanently impaired by the pandemic, which sectors are going to emerge as clear winners. But the bottom line is credit markets are not quite as optimistic as stock and bond markets. Lastly, the messages that commodity markets send about the health of the global economy is crucial. And here on my next slide, I remind everybody that unlike the Great Recession that started in 2008, the US no longer produces a majority of global GDP, even if it is still the largest economy in the world today. In aggregate, Brazil, Russia, India, and especially China produce a much more significant percentage of global GDP than they have before. They produce and consume commodities at an astonishing rate. So buoyant commodity markets are a sign of health for their economies and indeed the global economy. And to illustrate this, I'd like to remind you all of a quote. During the years 2010 to 2013, China poured more cement than the United States did throughout the 20th century. So that gives you a sense of just how important they are as the marginal producer and consumer of commodity markets. And in saying this, I want to remind you all to be careful to pass out gold and silver, or commodities that act more like a currency. You'll see that in the light blue line here, from the broader commodity complex in dark blue, such as copper, iron ore, nickel, things that go into driving global industrial production. In fact, the price of copper has become known as Dr. Copper for its forecasting ability of the global economy. As expected earlier this year, the commodity complex outside of gold collapsed, but have since quickly recovered, signaling that the Chinese economy has rebounded pretty robustly since its enforced draconian lockdown earlier this year. They, like the stock and bond markets, are signaling that the global economy may act as a tailwind for somewhere between a V-shaped and a Nike swoosh-shaped recovery here in the United States. So before I summarize these messages, I wanted to make sure you all understood the scale and speed with which the Federal Reserve and other central banks have acted to provide relief to the economy. And this particular chart looks at assets on central bank balance sheets indexed to 100 in January 07, measured in local currency, so that exchange rates don't affect the analysis. You can see how the Federal Reserve in dark red has absolutely ballooned its balance sheet, followed by global central banks across the world. This liquidity injection, coupled with the Fiscal Policy CARES Act earlier this year, in my view, are the key to reconciling the apparent great disconnect that has emerged between an economy in severe recession after the great lockdown and ebullient capital markets. At the current run rate, some estimates are that the Federal Reserve's balance sheet may reach $11 trillion by the end of the year. That is about half of our GDP. And equally significantly, they will end up owning half of the outstanding government and high-quality corporate fixed income markets. Think about that. That is what has allowed the stock and bond and commodity markets to look through the economic pain and unemployment of the balance of 2020 to a broad recovery that may take hold as soon as the second quarter of 2021. It is that liquidity, coupled with the PPP proceeds, that have boosted cash reserves and allowed companies to look through the near-term pain to a recovery next year. So in summary, I've tracked how these capital market indicators have evolved through time, all the way back from March 2019, where we, unlike many, said last year was going to be a continuation of the long period of economic expansion that we had enjoyed since 2009. And I'll remind you all that many traditional economic forecasters were calling for a somewhat premature recession in 2019. On the eve of the pandemic in early March, these indicators were actually suggesting that this year was going to be an even better year, building on the gains of 2019. Of course, with the unforeseen exogenous shock, these capital market indicators moved to recession levels overnight, but here they stand at the end of June, as I've illustrated on the slide. I would argue that the stock market is flashing a yellow or fair outlook. The bond market, with its positive slope, even though interest rates are likely to be low across the curve for a long period of time, is signaling a positive outlook. The credit market is the only one that is a little bit more pessimistic, suggesting that it's going to take some time for corporate bond investors to sift through the wreckage of the winners and losers and the likely defaults that are still to come from the recession. And then lastly, the commodity market is signaling a fair outlook. If you look at the copper price in particular on a year-to-date basis, that has already returned to a positive level. So net, I would argue that these capital market indicators today are actually supportive of the survey results that Joe outlined earlier today. That is that we should expect recovery to take somewhere between 6 to 9 months, or somewhere between the more optimistic V-shaped recovery that people were anticipating a couple of months ago, and more like a Nike swoosh type of recovery. These indicators are, of course, subject to change. And people often ask me, well, what are the risks to the general outlook from these messages? And I'd like to call out a few so that you can keep an eye on how these indicators change through time as we evolve through the next few months, which are likely to be tumultuous. Firstly, any disappointment in the progress towards medical therapies and vaccines that are now widely expected to be available next year could lead to these indicators being a little weaker than they are today. Secondly, a return to lockdown as the rise in Sunbelt and West Coast states threaten to overwhelm the healthcare system would also likely to be a risk to the outlook. I think the markets are going to turn their attention to this in earnest in the next few weeks, and that is, what are the implications for tax policy from a potential Democratic sweep in the November elections? Fourthly, if the optimism around the rapid assimilation of technological innovation from the Great Lockdown does not translate into the immediate productivity gains that many expect, may cause these indicators to be a little weaker. Fifthly, and this is the story around the next stimulus bill, any rise in permanent job losses from structurally impaired industries, which is a destabilizing economic force, is likely to lead to weakness from these indicators. For stimulus to be effective, it needs to be targeted in the industries that need the relief the most. It needs to be timely, and it needs to be temporary so that it does not cause a debt overhang in the future. Another important factor to consider is any escalation in geopolitical tensions between China and Russia. That would, of course, affect these indicators to suggest that the recovery may take longer than is baked into the cake today. And then lastly, and I know the Bolio brothers have been very consistent on this point to the Vistage networks, concerns about the long-term consequences of all the shock and awe fiscal and monetary stimulus of 2020, and whether that will set us on course for an unsustainable debt trajectory brought about by a slower than expected economic recovery. That will require higher inflation and a lower dollar over several years to correct. So keep an eye on those key themes as it relates to these capital market indicators in real time. So with that capital market outlook update, let me quickly turn my attention, as promised at the outset of this webinar, to Balentine's investing Cardinals. As I said earlier, they are in the spirit of Vistage legends Red Scott's business Cardinals, and hopefully they preempt the inevitable question of, how should I invest my portfolio today? These, in other words, are hopefully a timeless reminder to viewers about how to invest wisely, just as my capital market indicators are a timeless reminder of how to arm yourself with your own understanding about the future economic outlook. I was inspired to memorialize these by the many Vistage members who called to ask about our advice during the crisis and how to navigate it and beyond. And I've organized them into three broad categories: philosophy, strategy, and implementation. Let's tackle each in turn. Firstly, on the category of philosophy, always manage for risk, not for return. And by that, I mean the goal is to hit a return with the greatest amount of certainty and the least amount of risk when investing. It's about narrowing the fairway for all you golfers, the range of potential outcomes around a targeted rate of return. While it may seem to some like an overly conservative stance, investing becomes speculating when you take any more risk than is necessary to meet your financial goals. You need to understand the difference between your emotional willingness to take risk and your portfolio's actual capacity to incur that risk. Einstein said compound interest is one of the wonders of mankind. But if you don't manage risk, you are not going to allow the compounding effect of minimizing risk in down markets to work in your favor. Your greatest assets have nothing to do with money. What do I mean by that? Well, it's human nature to take a tactical view of investments. but this can cause you to take your eye off the big picture. Step back, devote time to thinking broadly about your investments and how they connect to your life strategy and your legacy. Investors who take the time to do this with their advisors give themselves the headspace to have truly meaningful breakthrough in conversations around their investments. Stay in control of your emotions, and boy, did March and April test that. It's okay to be optimistic. We are all optimistic by nature as entrepreneurs and business owners, but hope is not always a strategy. Effective investing demands extreme realism. We're all driven by emotion. Do whatever it takes to leave emotion at the door when it comes to financial decisions. By taking a hard, dispassionate look at things such as your true life expectancy or your loyalty to a particular stock, you can make more rational decisions about your investments. If this rule captures your attention, I recommend reading The Undoing Project by Michael Lewis. I also wrote a blog about it called Managing Your Business is Different than Managing Your Wealth. Focus on what you can control. You certainly can't control markets, so stay focused on what you can control. Elements such as liquidity, the amount of risk you are willing to take, active rebalancing, the fees you pay, and the taxes you incur when investing. And if you find yourself getting too hung up and stressed out on news of the markets, wondering if you should move this way or that, force yourself to tune it out. I know it's hard. The basic human impulses of greed and fear will always create market volatility, as I said in my cycle chart a few moments ago. Focus on working with your advisors to protect yourself from these natural human instincts and have a disciplined approach that enables you to use volatility to your advantage when appropriate. My colleague and partner Bradley Martin has written several blogs on this very subject, how the media feeds on market volatility to sell us all a story. Lastly, on the point of philosophy, know when to fire yourself, and that's very hard for us as CEOs of companies. And by that I mean know when to seek counsel and know when to step back and delegate. The qualities that make you successful in some areas in business may create blind spots when it comes to managing your money. You can still set the guardrails under which your advisor goes to work, but know when to let experts manage things for you. Let's turn to some investing cardinals around strategy. Firstly, know what you own and why you own it. Every investment in your portfolio should ladder up to your broader strategy. Even if you have a large team working on your behalf, you should know what you own, why you own it, and be able to explain it briefly, and also know what it's costing you. I was stunned at how many people came to our firm saying, I didn't know I owned that, or what is my consolidated view of the world? What is my true borrowing capacity? That relates to the second point on strategy. Make sure someone knows your big picture. Regardless of how many advisors or assets you have, take the prudent step of finding a single trustworthy advisor who has a global view of your balance sheet, both outside your company as well as in your company. This will ensure your advisors are synchronized and complementary rather than counterproductive to each other. Some clients are afraid to do this, but it's the only way to look at everything in totality and to uncover hidden vulnerabilities such as overexposure or a concentration to a certain sector or stock. It's the key to revealing subtle opportunities such as borrowing capacity, as I said a moment ago, that you may not realize you have. Thirdly, diversify forward, not backward. By that I mean the investment industry tends to give advice by extrapolating 100 years worth of historical data. But much of the time, and particularly in extreme circumstances, this backward-looking approach masks that stock markets, for example, can go for decades without generating a positive rate of return. By basing allocation decisions on future expectations, you can build up a system of moving chips and taking chips off the table to build up wealth outside your business and ultimately to make more rational decisions. If capital markets cannot be timed, a plan to diversify can. And you will see this if you download our capital markets forecast, which is an annual exercise at looking at what the prospective environment is likely to be. That is very useful for business owners to think about how much to retain in their company versus how much to take out of their company and diversify for risk mitigation purposes. Capital markets lead the economy. Well, that's what we talked about today in our update. It's more important to study the strong and weak signals that the stock, bond, credit, and commodity markets send in conjunction with each other. These are the more truest and most reliable expectations of the future economic environment. And then lastly, don't waste time timing the markets. Trying to time markets subjectively is a perpetual fool's errand. Even the most sophisticated investors make the mistake of trying to wait until the perfect moment to enter or exit. And I will remember the many conversations in late March and early April and the reasons not to act because people were waiting for the exact bottom in markets. Well, if you do that, you'll often miss a greater opportunity. Reacting to the market with constant tactical moves will rarely yield the desired outcomes. Make a plan to rebalance your strategy in a dynamic, disciplined way. Similarly, every business strategy needs to be course-corrected tactically along the way. We are very big proponents of the value add of an objective, rules-based approach to picking and choosing spots tactically along the way. Lastly, let's spend a few moments talking about implementation. And another lesson was learned the hard way during this recent pandemic episode. Cash must be cash, and fixed income should be boring. Cash and fixed income assets are not meant to enhance returns. They should act as a ballast to a portfolio and enable resiliency. That is the reason we said in our April webinar how important it is to have 2 years worth of cash and cash equivalents at the ready, whether investing in your portfolio or managing your business. This liquidity buffer is hands down the best defense against low probability but high impact shocks and black swan events like what we are in the midst of experiencing. That cash buffer buys you critical time when the unexpected hits and guards you from the real risk of capitulation, the panic selling that can permanently impair capital. My colleague and partner David Damiani was featured in the CFA Institute's quarterly journal years ago in the midst of a long grinding bull market when complacency set in, making this very important point. We've been saying this for over a decade, and frankly, it has been absolutely crucial for the advice we have given both our clients and business owners in navigating the crisis over the last few months. Remember also that leverage can be a double-edged sword. Business owners and executives know how to use debt strategically as part of an overall capital structure to drive growth. But using leverage in the stock and bond markets when you don't control the outcome, i.e. borrowing to boost returns, can quickly turn devastating. Be exceptionally cautious of tactics or products that use leverage, or you could end up facing a margin call and be forced to liquidate at precisely the wrong term and risk permanently impairing your capital. Be very careful when dabbling in private markets. The private markets offer compelling opportunities relative to public markets, but they're also particularly fraught with unique risks. Know when to say no to certain ventures and when to say no to friends and family who approach you about investing in various endeavors. When in doubt, always consult your advisor. And whatever you do, don't hide private investments from your advisors. They need to know your full picture in order to give you the best possible advice, as I touched on a few moments ago. We have a private capital team here at Balentine, and as Vistage members, I would be happy to make the introduction if you'd like to help figuring out if and how much exposure you should have in your overall portfolio to private markets. Don't mistake products for advice. The markets are a product-generating machine, designed to sell products in exchange for often egregious fees. Listen to advice and pitches with a discerning ear. Don't mistake a product or a tactic with a big picture solution or with objective expert advice. Demand thought partnership above product pushing from your advisor. Reject jargon and demand straight talk. The investment management industry is notorious for hiding behind jargon and technical terminology. Catchphrases like beta, standard deviation, or growth models can all sound dazzling, but those with true command of a complex subject should be able to speak of it in elegantly simple terms. Challenge yourself and your advisors to talk about your investments in the plainest possible terms. The more in command you are of your subject matter, the simpler you can explain it, and the more likely your expectations will be met. Our investment Cardinals have been is readily available as a document, and I'm also preparing a longer talk on this to several Vistage groups to dive deeper into the rules and how to apply them if you're interested. I'll share with you how you can receive them in a moment or two. We have many resources available, and I know how Vistage members appreciate a good resource. I've presented a lot to you today and want for you to have access to whatever would benefit you. So to simplify, just go to our website, and if you register at this Vistage page, you will send a consolidated list of resources that I've referenced today. All of the resources we referenced today are on our website if you prefer to peruse. One of our commitments at Balentine is to be a convener of discussions and to help people think ahead strategically beyond the near-term tactics of managing through the crisis. Eventually, we will get to the other side of this crisis, whether it is a V or a Nike swoosh or a U-shaped recovery. In this vein, we launched our own Road to Recovery series that pulls in thought leaders and experts across different industries to share their unique vantage point on what lies ahead. To look at the road to recovery from a private equity and venture capital perspective, we hosted experts from 3 venture capital firms with vantage points around healthcare, fintech, and IT. We also had a fascinating interview with our supply chain channel. Daria Faroukwi, the former COO of the City of Atlanta and a board director of the Intercontinental Exchange. She is now the president of Point A, which is a supply chain innovation organization founded by Georgia Pacific. And that panel also included Griff Lynch, who is the CEO of the Georgia Ports Authority, known as Georgia's and indeed the Eastern Seaboard's gateway to the world. Our panel brought together complementary vantage points around supply chain innovation and how supply chains are moving from a just-in-time to a just-in-case footing, and how software that drives logistics and importing and exporting are evolving. It is a fascinating panel for those of you that rely on supply chains to do their business. The next in our series, we'll be hosting our very own Joe Galvin, along with Frank Blake, the former CEO of Home Depot, who's currently the chairman of the board of Delta Airlines and Grady Memorial Hospital here in Atlanta, to discuss how we can practically reopen the economy and other more pressing questions. So we'll have vantage points for businesses of every size and scale to walk through implications for business owners and the economy ahead. And we will rely on Joe to represent the voice for our Vistage network. All too often, as I've said before, the national dialogue is about big business and Fortune 500 companies, and not enough about the entrepreneurs and the risk takers and the business owners within the Vistage network that do so much for creating jobs in our economy. And lastly, I'd be remiss not to share with you all about my forthcoming book, which I'm writing with my chairman, Robert Balentine, who Joe referenced at the outset, is also a longtime Vistage member. Our firm works with entrepreneurs, and as entrepreneurs ourselves, we've learned a lot about not just how to run and scale a business, but the implications within families and the many transition business owners face. So together with Robert, we are releasing a book this fall to help entrepreneurs sort through what they should be asking themselves and to explore how to set themselves and their families up for success. Being so immersed in day-to-day business affairs often prevents entrepreneurs and business owners from anticipating and preparing for the many forks in the road of their entrepreneurial and life journeys. And so the purpose of this book is to uncover the questions they need to ask themselves throughout their journey so that they can stay in control of their own destinies, shape their legacies, and pass on the fruits of their labor, and perhaps most importantly, live lives of fulfillment and meaning. As I said earlier, our cardinal rule is your greatest asset has nothing to do with money. And that topic is explored in detail in this book. So you can learn more about that at firstgenerationwealth.com. So thank you very much for indulging me on this webinar. I hope I've left you with some timeless tools, not just understanding the lenses of capital markets to think about what the future may hold for your business, but also some timeless tools or investing cardinals that will help you think about how to manage your overall balance sheet and the liquidity that you have outside of your business. So with that, Joe, thank you for inviting me back. We look forward to having you on our panel in a couple of weeks representing the voice of Vistage, and I'll take any questions that you think might be relevant.
Great, Adrian, thank you so much. That was borderline overwhelming with the amount of information that you brought in. I'm waiting for that book. That's very important to me, and I can't wait to be on that panel with you and bring the real voice of what small and mid-sized business CEOs are thinking about and what they're doing as well. A couple of questions that I had to ask, that I wanted to ask you, and it really deals with your perspective. It says markets look ahead.
Yeah.
You know, the markets have looked ahead and they see, you ran down your risk factors, but the first one was that a disappointment in the science.
Yeah.
Right. The markets have made a big bet that our scientific community is going to come forward with a vaccine or some, medications that is going to make this go away. Between now and then, there's obviously a gap, and we're all trying to figure out what that means. We're seeing other parts of the world, specifically Europe, China, Asia, doing a much better job of flattening and maintaining their curve than what we're experiencing here today. When the medical solution, when the scientific solution comes out, will our response and the haphazard response to that, will that have an impact on how we're positioned after the fact? Meaning, you talked about GDP coming into this and how US, China, Europe, all that fit together. Will there be a fundamental shift when we get to the other side of this and we're back to the new reality when we can just engage with humans?
Well, I think it's important to bear in mind that I think it's unrealistic that if we find a vaccine and it becomes effective and it becomes readily available, I mean, think about the logistics of just making 300 million vaccinations available.
And that's just for us.
That's just for us, right? I think it's unrealistic to think that the world will go back to normal like it was in late 2019. Clearly, this pandemic is going to highlight some important enduring changes in the way we go about doing business. I think about in my own business, the amount of frivolous business travel that we used to undertake, where so many introductory meetings can now be held by Zoom. I think about the unnecessary travel between, Atlanta and our Raleigh office that can now be done effectively by Zoom. I contrast that with, there is nothing like having an in-person meeting with somebody to truly understand communication. So, perhaps things like business travel become permanently smaller. And think about the knock-on consequences for the airline industry, which is why I'm so excited to have Frank Blake on our panel to talk about how Delta is seeing it. I think about the knock-on consequences for commercial real estate and how people are going to be using and optimizing office space. There is a company that I'm aware of in the Vistage network in my industry that are already offering their employees the permanent ability to work from home. And how we as Vistage members think about the advantages of offering, flexible work hours to our employees as a means of attracting talent against the need to continue to nurture a collaborative culture, that Speaker David Friedman talks a lot about. So that's another thing that I think through how the global pandemic has think the way we think about the world. And then lastly, this issue of supply chains. I think is going to, I encourage everybody to listen to that webinar, because how the Georgia Ports Authority responded and pivoted. And by the way, you'll hear Griff talk about how much is on the water today coming into the United States through the Georgia ports as a result of catching up during the lockdown, which I think is an important indicator as to how the economy is likely to evolve in the next few months. But this idea that, the low-cost country, China, should be at the epicenter of your supply chain because it's going to drive profitability is really being rethought. And of course, this was first discussed last year in the context of the unfolding tariff war, but really the pandemic has accelerated that. And, there are stories of companies building two supply chains for just in case, onshoring jobs into the United States. There's a fascinating story in that supply chain webinar where Eddie Capel of Manhattan Associates, which is a logistics software publicly traded company, have had to pivot to help restaurants change the way they do their business from seating everybody to offering, takeout, and doing so reliably. So I think those are the important trends that we will be discussing, in this Road to Recovery webinar. And I'm excited about thinking about how we at Vistage can ask subject matter experts to give us an insight into that. We've already asked Dean Menudo, who's a celebrated speaker, to come talk to our group about how to cause and affect a sale in an online setting as opposed to in person. So I'll be interested to see what Dino has to say about that.
Yeah. Well, there's no question this has changed customer dynamics, talent dynamics, operational, the new workplace. You'd mentioned the back to work. We commented on that in April, that genie's out of the bottle. And we're going to have to figure out during this transition, we'll maintain that hybrid. But once you get to the other side, do you go back to must be in office? Do you go to fully remote? Or do you stay in this hybrid world where, depending upon who you work for and how you work for, that not being seen in the office might be equated to not being effective. So there'll be some real cultural shifts that'll occur on the other side of this. You mentioned the next stimulus package that's being brewed, for lack of a better phrase, in Washington these days. Assuming that comes out, that's just going to bridge us to the eventual scientific solution. Is that correct?
Yeah, well, I think that is the hope. Further rounds of stimulus are there to help us get to where we, can find a readily available therapy or vaccine that's widely distributed. And so, unfortunately, this next round of stimulus has already succumbed to all the usual disappointing political horse trading. Back in March and April, they were able to effect a bipartisan consensus pretty quickly as we stared into the abyss. But now that things are sort of muddling through and we've reached that plateau, unfortunately, it's become subject to political football. And as I said during my remarks, a purely technocratic assessment of effective stimulus is that it is targeted. So it really hits the industries and the jobs that are most affected. The last few months of jobs reports have come in ahead of expectations, but that's really just capturing all those people that have been furloughed coming back to work. Yeah. If you squint through the details, unfortunately, there's a disturbing trend of slowly rising permanent job losses in some of these industries that we've just talked about: leisure, hospitality, travel. And how the stimulus hits those areas in a timely way and in a temporary way so that it doesn't just add to our long-term debt consequences is going to be absolutely key. And I hope that they are able to provide more relief in a responsible way. As I said, the current administration has every incentive to try to get that done before the election, because they would obviously want a stronger economy than today as we head to the election polls. But it is also interesting for me to see candidate Biden lay out their economic agenda or potential economic agenda, which would be not necessarily to repeal all the corporate tax cuts from the 2017 Jobs Act, but to move it back halfway and to use those funds for long-term infrastructure spending. If you look back in history, when we've experienced severe recessions or near depressions, call it a mini depression, infrastructure spending has been a way to get people back to work. And so we've written about this on our website, and that to us looks like a compelling long-term investment theme. But, if I were to handicap where the agenda goes, if candidate Biden were to win, that would be the direction of policy that I think we should think about as we manage our business in 2021 and beyond.
Adrian, I could literally spend the rest of the day sitting here asking you questions and listening and learning. Unfortunately, we're at the end of our time together. So I'd like to say thank you so much for joining us again today. I hope you'll accept an invitation to come back in a couple more months and give us an update and see where we're going. I certainly am excited to be part of your webinar the first week of August and to work and meet Frank Blake and talk about and bring the SMB perspective. So that's coming up in early August. Look forward to that. And in the meantime, again, thank you so much for sharing your insights. We appreciate what you have done. For all of you that have attended today, all the materials, our reports, Adrian's reports are all available. And we hope this has given you some food for thought as you begin to plan and continue to plan how you're going to navigate through this crisis until or such time that we get that vaccine in place and then we get it distributed. It's going to be a long and interesting journey for all of us, and certainly something we'll all remember. So Adrian, thank you again. Greatly appreciate to our members and everyone listening. Have a great day. Take these insights, make better decisions, become a better leader, and you'll get better results, and we'll all come out of this much better. So thank you all very much and have a great day.
Thank you.